Want to know how you can earn passive income every month through dividend investing? Today we're looking at a dividend ETF portfolio strategy that's changing the game for investors. We'll show you how just 6 carefully chosen ETFs can put you on the path to building wealth. This isn't about quick gains, it's about creating a steady income stream that grows over time. We'll compare this approach to traditional savings methods and explain why more investors are getting on board. While everyone's results are different, we'll give you a realistic idea of what to expect when you start using this strategy. Ready to learn how you can take charge of your financial future and boost your investment game? Let's explore dividend ETFs and uncover how to build a strong passive income stream. Meet Alex and Sam, two 25-year-old friends with similar jobs and starting points. Their money choices over the next 5 years will shape their futures in ways they don't expect. Alex plays it safe with money, like many people do. He puts his savings in a low-interest account and sometimes buys popular stocks. Sam, on the other hand, tries something different, investing in carefully picked dividend ETFs. The difference between what Alex and Sam do is pretty big. Alex's savings account probably earns about 0.05% interest. Sam's dividend ETFs could make more money and grow over time. When Sam gets dividends, he can use them to buy more shares, which could mean even more money later. Here's why this matters. Sam's approach could lead to much bigger returns. These ETFs might not only pay out more, but they could also increase in value. It's kind of like planting a tree that gives you more seeds each time you harvest it. We'll follow Alex and Sam for 5 years to see how their choices play out. You'll see how small decisions can add up to big differences. It's not just about how much money they have, it's about what they can do with that money. Keep in mind, there's no perfect way to grow your money that works for everyone. But by looking at both Alex and Sam's stories, you can learn more about different ways to handle your own money. Let's see what happens to Alex and Sam over the next 5 years. While Alex sticks to his traditional savings approach, Sam discovers a game-changing financial strategy: dividend ETFs. These investment vehicles offer a way to earn passive income without the hassle of managing individual stocks. Sam's excited to find ETFs like JEQ with its 10.1% yield and SCD, which offers a 3.78% dividend from established, profitable companies. He knows not all dividend ETFs are the same, so he carefully picks a mix of growth and income-focused funds to build a balanced portfolio. This way, he can aim for high yields while also focusing on stability and long-term growth. As time passes, Sam sees small but steady payments coming into his account. It's not huge money yet, but it's a start. Each dividend feels like a little win, showing his strategy is working. Meanwhile, Alex's saving account barely keeps up with inflation. Sam likes how easy his approach is. The ETFs give him consistent income without needing to constantly adjust his investments. It's great for someone who wants to build passive income without becoming a full-time investor. By mixing high-yield ETFs with more stable ones, Sam creates a portfolio that aims for both income and lower risk. It's a plan designed for growth and stability over time. After the first year, the difference between Alex and Sam's strategies is clear. Alex's savings have grown a bit, but Sam's portfolio is actively making money. Every month, his dividend payments go up, even if it's just by a few dollars. It's a real sign that his money is working hard for him. But this is only the beginning. The real power of Sam's strategy will show up over time. As we look ahead, we'll see how this small difference starts to grow, potentially leading Sam to financial freedom. Remember, it's all about making smart choices consistently. Sam's just getting started, and there's more to come. Ready to see what happens next? Let's check out year 2 and beyond, where dividend investing really starts to shine. 3 years have passed, and Alex and Sam's money moves are looking very different. Let's see how they're doing. Alex has been saving hard, and his bank account is growing, but the returns are tiny, barely beating inflation. He's getting annoyed watching his money crawl along. Those safe, low-interest rates now feel like they're holding him back. Sam, though, is seeing his dividend strategy pay off big time. His ETF portfolio, including that JEQ fund with its huge 10.1% yield, is now a big chunk of his monthly income. By putting his dividends back into more shares, Sam's creating a snowball effect. Each payment buys more shares, which means even bigger payouts later. Let's look at the numbers. Alex's savings have grown in a straight line, but Sam's investments have shot up. Sam's portfolio is worth way more now, thanks to the market going up and all those reinvested dividends. This really shows how different their strategies are. Sam's money is always working, even when he's asleep. Dividends automatically buy more shares, no effort needed. It's like having a non-stop money-making machine. It's not just about the cash for Sam. Getting those regular payments has made him feel more confident as an investor. He sees his money growing and feels more financially stable. Alex, with his tiny returns, doesn't get that same thrill. After 3 years, the gap between Sam's dividend ETFs and Alex's savings is huge. Sam's not only beating inflation, he's got a growing income stream too. Compound interest and high-yield ETFs have put Sam way ahead. Alex's savings are safe, sure, but they're not growing like Sam's investments. It shows how putting your money to work can beat just saving it. As you think about your own money, ask yourself, do you want the safety of savings or the growth potential of dividend investing? As we enter year 4 of Alex and Sam's financial journey, the market takes a dive. This sudden downturn puts their strategies to the test. How will they handle the economic turbulence? Alex, who picked a few popular stocks along with his savings account, starts to panic. His stocks are dropping fast, and his small gains are disappearing. Scared of losing it all, Alex thinks about selling everything to cut his losses. Sam, however, stays cool despite the market chaos. His mix of dividend ETFs helps cushion the blow from the market's wild swings. But why? The answer lies in the types of companies these ETFs invest in. Let's look at Sam's SCD ETF. This fund picks stable, well-established companies that have proven they can handle tough times. These aren't risky startups, but solid businesses that have made it through economic storms before. Even with the market falling, Sam keeps getting regular income from his investments. The companies in his dividend ETFs are still making money, and many keep paying dividends even when times are tough. It's like getting a paycheck from your investments no matter what the market does day to day. Sam's strategy is all about staying power. His ETFs focus on dividend aristocrats, companies that have raised their dividends for at least 25 years straight. These companies are usually more financially stable and better at handling economic problems. This gives Sam's investments a safety net that Alex's individual stocks don't have. As the market starts to bounce back, we see another plus to Sam's approach. His portfolio recovers quickly, with many dividend-paying stocks coming back faster than the overall market. This quick recovery is typical for dividend stocks, which tend to hold up better during downturns. Alex, on the other hand, is in a tough spot. If he sold when things were bad, he's missing out on the recovery. If he held on, he's still dealing with the stress of picking individual stocks. Either way, his situation looks rough compared to Sam's steady, income-producing portfolio. By the end of year 4, the difference between their approaches is as clear as day. Sam's strategy not only protected his money, but kept bringing in income through the downturn. He's coming out of his tough time with his financial plan intact and even stronger. This part of Alex and Sam's story teaches us an important lesson. You need a strategy that works in all kinds of markets. It's about building a portfolio that can handle the ups and downs of investing. Sam's dividend ETF approach has shown its value, giving him stability, income, and peace of mind, even when the market got rough. As we wrap up our story, Sam reveals another key part of his strategy. Tax-efficient investing. Alex is about to learn a tough lesson about how taxes can eat into investment returns, while Sam has been quietly using a Roth IRA to boost his dividend strategy. Dividend income in a regular brokerage account can be taxed at rates from 22 to 32% or higher. Alex is in for a shock when he sees how much taxes are taking from his investment gains each year. Sam, though, has set up a tax-free growth machine with his Roth IRA. All his dividend earnings in the Roth IRA grow without taxes, so his returns compound faster. Let's look at some numbers. If Sam and Alex both put $10,000 in a high-yield ETF paying 10% dividends yearly, Alex would end up with $750 after taxes in a taxable account with a 25% tax rate. Sam keeps the full $1,000 in his Roth IRA. Over 20 years, assuming they reinvest and there's no growth, Alex would have $41,772, while Sam would have $67,275. That's $25,503 more just from avoiding taxes. Sam doesn't stop there. He spreads his investments across both taxable and tax-advantaged accounts. In his taxable account, he focuses on growth ETFs, which get better tax treatment when held long-term. The key is putting the right investments in the right accounts. By keeping his high-yield dividend ETFs in his Roth IRA, Sam avoids taxes on all those dividends and their growth. This smart approach to taxes shows how Sam thinks about every part of his investing strategy. It's this kind of attention to detail that helps Sam get ahead faster. As we finish this part of Alex and Sam's story, think about your own investments. Are you using tax-advantaged accounts like Roth IRAs? Do you think about taxes when you choose investments? Remember, being smart about taxes can really boost your long-term returns and help you reach financial independence sooner. Take a look at your portfolio and see if you can make it more tax-efficient. You'll thank yourself later. We've reached the final chapter of Alex and Sam's 5-year journey, and the results are eye-opening. While Alex has saved a good amount, he's not making any passive income. Sam, however, has done something amazing. He's now earning $574 every month from his Dividend ETF portfolio. Let's look at how Sam did it. Sam picked a mix of Dividend ETFs that work well together. His top performer is JEQ, an ETF with a big 10.1% yield, but he also has others like SNS and SCD. By spreading his money across different ETFs, Sam's built a strong income stream. The cool thing about Sam's approach is that anyone can do it, whether you have a little money or a lot. It's all about making smart choices consistently over time. This extra $574 a month has changed Sam's life. He feels more secure financially and can make career choices based on what he loves, not just what pays the bills. He can take some risks now, knowing he has the extra money coming in. Over the years, Sam's strategy has brought in almost $6,000 in passive income. That's a lot of money that can cover expenses or be reinvested to grow his portfolio even more. It shows how powerful dividend investing can be. Looking at Alex and Sam's stories side by side, we can see a big difference. Alex has been saving, but he's missing out on making his money work for him. Sam's portfolio is growing and giving him a steady income. Think about which path you want to take with your money. Are you interested in creating ongoing passive income? Sam's story shows that with the right approach to dividend ETFs, you can make financial freedom a reality. Remember, it's not just about saving money, but about making your money earn more money for you. Sam's journey shows how powerful a well-planned dividend ETF strategy can be. It's all about making smart, consistent choices that grow over time. Anyone willing to learn, plan, and stick with it can work towards financial freedom. Want to start your own dividend investing journey? Here's what you can do. 1. Open a brokerage account if you don't have one yet. 2. Look into dividend ETFs and pick one that fits your goals. 3. Set up automatic monthly investments even if it's just a little at first. 4. Think about using tax-efficient accounts like Roth IRAs to boost your returns. Using these actions helps you keep more of what you earn so your wealth can grow faster. Think about how this could change your financial future. The most important thing is to start now and keep at it. Every step you take builds momentum towards your money goals. So why wait? Start using dividend ETFs today to work towards your own financial success.